Good morning, everyone. Welcome to Windsor Brokers live daily markets outlook for Thursday, 29th of November 2012. The U.S. So-called Fiscal Cliff, of course, is the top subject for today. Basically, yesterday's sharp movements in the markets were caused by initially negative news and then some positive positive tones came out, signaling that possible solution for the so-called fiscal cliff is quite likely, with confirmation also coming from President Barack Obama. As a result, the euro eased yesterday below 129, but losses were limited, and after some comments from U.S. Policy makers rekindled hopes for a deal to avoid the sharp fiscal tightening that could hurt not only U.S. but global economy. The top loser yesterday was gold, that dipped below our supports that we saw yesterday as good ones at 1735, 1730, dipping as low as $17.05 per ounce, with some recovery up to 1723 seen afterwards on again these positive comments. Also, the other currencies have suffered some losses. The sterling dipped to 159.60. Dollar yen remained mainly unaffected. Did not show any stronger movements. Basically dipped down to 81.68, but recovered quickly, while dollar Swiss is again back at the levels below 93, following yesterday's reversal and the failure to hold the gains above 93, again caused by the recent movements. The crude oil also lost ground, dipping to levels below 86, our critical support, and dipping as low as 85.35. Now we're introducing 85 level. With the gold, we commented already. As said, U.S. officials and the House Speaker, actually, the top Republican Congress, voiced optimism in his comments yesterday that Republicans could broker a deal with the White House to avert a fiscal crisis, even though he repeated his opposition to raising income tax rates on high earners. On the top of all these comments, President Barack Obama said that he hoped to reach an agreement with Congress before Christmas. Of course, increased fear among the investors is seen in case of tax increases and the spending cuts that is due to start at the beginning of next year, and is totaling about $600 billion. That could tip the world's biggest economy into recession and depress the global economic outlook. So we're really talking about big stuff. I mentioned yesterday in our comments, and nothing special to repeat again, but some positive tones that started coming. We mentioned yesterday that basically Republicans and Democrats were still away from any deal and any agreement, though some positive comments that came yesterday now shook the markets, and they're seeing more optimism in the outlook for possible finding a solution and agreement that will avoid the currently likely plan of tax increasing and the spending cuts that will, of course, not only affect not only U.S. but worldwide economies. From today's calendar, that is quite big. We have to take a look at this Germany unemployment change that is due at 8:55 GMT is expected to show some decrease in the German unemployment. 17,000 is the figure forecasted compared to 20,000 in October. The other significant that has already been released is this GDP for third quarter of Switzerland that came in quite surprising, 0.6% growth compared to 0.2% in the second quarter, and the 0.2% forecast, and the draw of 0.1% in the second quarter, surprisingly showing good results of movements in the Swiss economy. A batch of data from UK starting at 9:30 GMT with the mortgage approvals and the M4 money supply. Mortgage approvals are forecasted at 52,000, slightly higher than 50,000 in the month of September, while money supply is forecasted at 0.4% against 0.2% in September. Bank of England financial stability report and the Bank of England's Governor King's speech are due at 10:30, and of course this is also one of the today's focuses. We're going to take a look and follow what the King will say. As also the UK economy is not in the great shape at this point, of course affected by the crisis worldwide, and of course comments from Governor are quite important at this point. I don't have any prepared forecasts and comments about this, so it's just to see what he will say, and then we will be commenting later on in case of any stronger market movements. UK's realized sales for October are due at 11 o'clock. And then from US we have the preliminary GDP for the third quarter, quite supportive, and the optimistic forecast for today, 2.8% in the third quarter is seeing a growth of the US economy compared to 2% in the second quarter, with the current account, with the unemployment claims due at the same time at 13:30 with 404,000 new claims, slightly lower than the previous week's 410 claims. As we can see, the data are a bit mixed at this point, as pending home sales are again expected positive at 0.9% in October compared to 0.3%, and from that will be all from states. From Canada, we have current account at 13:30 for the third quarter, widening of the gap to 18 billion Canadian dollars compared to 16 billion dollars in the second quarter, is seeing that current account, the current situation is worsening in the current account of Canada, widening the dip. And basically that will be all. Some data from Japan, actually important PMIs and the unemployment are due late in the afternoon. That will be falling in the next day. Manufacturing PMI, we don't have the forecast for October. 46.9 is the previous release. Unemployment rate is expected to stay unchanged at 4.2%. This is mainly going to apply mainly on the next night session, Asian session, that will be mainly affected by releases. National core CPI in Japan is expected to stay unchanged at minus 0.1%, the same like Tokyo's core CPI at minus 0.4%, and the household spending is slightly to improve to minus 0.8% compared to minus 0.9% in the month of September. Thursday is set quite busy calendar, so we'll keep an eye on releases of the economic indicators, and of course focus on the Bank of England's governor's speech. And now we're going to take a look at the technicals and see what we can expect on today's movements. As shown on the hourly chart, the euro is recovering ground after a dip from 130.07, 27th of November peak, hitting 128.80. This is quite a strong and important support at this, as this marks 38.2% of the rally recovery rally from 126.60 to 130.07, with the 55 days exponential moving average ascending and the Fibonacci support so far containing the dips, offering good support, and the quick recovery and now is aiming above 129.60. This was the originally during the night the price was limited at this point. Now fresh strength seen on the opening of European session, seeing potential for further extension higher. A positive tone that is dominating on the hourly chart, that basically regained the positive tone after a recovery above of 128.80 and break above 129. Now sees again a focus towards the upside, but another thing is the quite weak, still weakening 4-hour indicators, and the lack of momentum, loss of momentum basically at this point is still raising question mark. As long as we don't see break above 130 as our break point on the upside, 130, 130.20, there will be still more risk for further consolidation or possible further easing, as a loss of 129.00 and 128.80 could be a trigger for a deeper reversal of the corrective action from 126.60 to 130.07. On the daily, on the daily chart is still some improvement seen in the current studies, but still lacking strength for a push higher. Basically, it's consolidating the latest rally from 126.60 to 130.07 with the upper Bollinger of 20 days at 130.00 so far limiting the gains, but overall positive tone exists as MACD breaks above the midline, and evident is strong momentum building up on the daily chart. But warning point is the reversal of the stochastic and the sideways movements of RSI on the 25 days on the daily chart that still sees a possibility of further consolidation and sideways movements, and of course lack of strength to clear 130.00, 130.20 would still keep the downside vulnerable for a possible repeated test of the downside supports at 129 and 128.80. And a similar situation with the sterling, with the repeated 4 dojis in a row on the daily chart, basically seeing the current uncertainty in the market and the indecision or probably in the possible further reversal, as initial gains were capped at 160.50 where the double top was left, and the immediate bearish reaction dipped yesterday to 159.60. This is also marking a 38 pardon, this was the low of yesterday where the support was found, and subsequent bounce above 160.00 is still lacking strength to clear initial barrier at 160.20 where the gains were capped so far. Failure to stretch higher and possibly retest 160.50 could still see risk of reversal below 160.00, as hourly studies are outside this point neutral to negative with the slight move above the midline on the MACD, and the losing momentum at this point following yesterday's build up to 160.20. It still sees probability of further reversal, basically raising the question mark above the current bulls, unless we see break above 160.50 clear break that will signal the resumption of the recovery rally from 158.26, and basically this is close to 61.8%, slightly above it, of the down move from 161.74 to 158.26. More risk will be still seen towards the downside. 2 days, 4 hour, 20 days exponential moving average is so far containing the downside at 160.05, but a loss of 160 as initial support could be a trigger for further easing with the 159.60 seen next, as a quite negative tone is now seen on the 4 hour chart, as most of indicators are descending, and the loss of initial bullish momentum threatens retest of 160.00 and probably stretch below 159.60. That will open another important support at 159.00. Conversely, of course, break above 160.50, 160.55 is to open next strong barrier at 161 zone that marks 76.4% retracement at 160.92, and 160.00 as a round figure and psychological resistance. Dollar yen recovery from yesterday's low at 81.68 remains now capped at 82.20. This is also descending trend line of 82.83 through 82.61, with congestion seen during the Asian session trading just under 82.20. But overall, it's still positive tone seen on the hourly chart. sees potential for possible break above here as immediate support seen of 10 days exponential moving average currently standing at 82.10 and maintaining basically the rally on after breaking above 81.85 approximately. The 4-hour structure is more negative at this point as indicators are still below their midlines with the sideways movement seen on the RSI 14 days still holding above 7 days moving average but moving sideways, and the 14 days rock is above the midline and above the 7 days moving average, pointing higher, though more negative is seen current reversal of stochastic. That is just a signaling reversal with the momentum holding below the midline, seeing again more risk towards the downside unless we see the clear break above 82.20 and 82.30 that marks yesterday's, 2 days ago high at 27.00. More risk will be still seen towards the downside as basically the pair remains in the downtrend from 83 peak of last week, 22nd of last Thursday, 22nd of November, and a break above this barrier that also marks approximately 50% retracement of the down leg from 82.83 to 81.68. Lack of strength and failure to break these levels could be a good signal and risk of fresh lower top under the trend line and a fresh slide as break below 82.00 will accelerate losses down towards initial support at 81.68 and probably open way towards more significant supports at 81.39 and 81.00. 38.2 and the 50% retracement, also the upper and the lower boundary of the consolidative range seen between 15th and the 20th of November 2012. This was the consolidation following a rally to initial high at 81.45, 81.58, and basically break below these levels could be a signal for some stronger corrective action of the broader 79.06 to 82.83 descent. And finally, the dollar Swiss has lost ground following yesterday's, as we can see on the ADX, bears are now gaining strength as the pair accelerates losses on the 1 hour, and the 4-hour chart. Bears are now just building up their momentum, giving away towards bears giving way to bulls on the recent upside rejection at 93.38. As we can see, recovery from 92.53 2 days ago low that gave initially good signals as we saw the break of 93.00 and the regain of 93.30. This was our initial resistance with the 93.39 seen as a high where a reversal occurred. Basically, the gains were limited by descending 55 days exponential moving average, and a failure to break higher has seen a fresh, basically the hourly, failure, I do apologize, a failure to extend gains above 93.30 seen as a break point in the near term triggered a fresh weakness as basically the larger picture outlook is still holding negative tone despite the pair being entrenched within the range. It's still more focusing towards the downside as reversal from 95.11 broke below good support, and at 94.00 also 200 days moving average, shifting more focus towards the downside on the larger picture as we lost 93.00 and currently the pair is accelerating losses. Immediate target is at 92.53, 27th of November low, with the break here most likely to open way for full retracement of 92.13, 95.11 rally, and test the key support and the near-term base at 92.13, break of which of course to signal resumption of the broader downtrend from 99.70 that might open next downside levels at 91.50, 91.00, and then we have lows at 90.41 and 90. 00 and 89.29. These are all seen on a clear break below 92.13 and 92.00. As said, near-term focus is still towards the downside, as negative hourly and the 4-hour situation sees downside focused, and the only bounce that is quite unlikely at this point, the bounce above yesterday's high at 93.39 would avert immediate downside risk and probably introduce some stronger corrective action of the fall from 95.11 down to 92.53. Otherwise, 92.53 remains in the near-term focus, and of course, a break of which opens key near-term support at 92.13. The crude oil, as we said at the beginning, lost traction and dipped as low as 85.35. We broke below the trend line support. We lost the supports at 86.36, 86.16, and 86.00. Testing levels just close to 85.09, the previous lows of 13th and 15th of November, with the more negative tone now seen as the price attempts towards the lower boundaries of the recent range, better seen on the daily chart. Despite some recovery attempts, the initial positive tone on a bounce from 84.05 has now been seriously dented, as we set the upside rejections at 89.20 and 89.77 now, and loss, of course, of 86 handle, seeing a more focus towards the downside. The immediate bounce higher that regained the levels close to 87.00 still needs to work a lot, to say it this way. Basically, we need to see the regain of 88.50 in order to reintroduce the upper barriers. Otherwise, more pressure will be seen towards the downside, as 4-hour studies are still negative and building up a bearish momentum, with the hourlies now improving. The fresh momentum is seen on the hourly, but MACD is still below the midline. Still, as said, we need a lot of gains above 88.00 and 88.50 in order to improve the near-term structure. Daily indicators are now below their midlines, with momentum now attempting, and all the others are still in the descending mode, seeing again more potential following the upside failure to regain 90.00 and 90.40 hour break points, with the descending 55 days exponential moving average currently at 89.27, maintaining the current slide, as well as crossing below 90 days moving average as shown on the daily chart. Of course, break below 85.00 would reintroduce our key support and base at 84.00, while any improvement requires a gain of minimum 88.50 in order to refocus upper boundaries 89.20 and 89.77. And the gold has lost ground on yesterday's sharp fall. This was a good reason to say that it was the top loser of yesterday's trading. Basically, break we expected in yesterday's technical outlook for commodities that the gold will, in a way, be protected on the downside, despite being the 1738 initial support being dented, but loss of this level and the 1734, and of course the trend line support at 1733 currently accelerated the losses, dipping as low as 1705. This is our initial support. The good support was found here. Basically, this was the last barrier below that was guarding the recent low at 1672, and so far it held the sharp dip from yesterday. 1705 acted as a good support for now. We have 1705 and 1700 as a good support zone, and basically break of this level could be much more bearish at this point. However, the negative tone now dominates on the lower time frames studies, as both 1 and 4 hour indicators are well in the negative territory, with some momentum being built on the hourly chart, as Oil regained, gold regained 17.23. This was one of our previous lows and support, 17.19. So basically initial resistance has been regained, but more pressure is still seen towards the downside according to the technicals that are still quite negative, unless we see regain of levels at 1730 and 1735. Basically there is also the broken bear trend line and the attempt of 20 over 55 days moving average crossover. That will put additional pressure. More focus will be again seen towards the downside. Break above 1730 and 1735 would avert immediate downside risk and likely reintroduce upper barriers 1738, 1746, 48 and 1752. Recent rallies top posted 3 days ago at 26th of November. That was all from me. Please, if you have any questions, you can submit them now. Okay, except many thanks from all of you. No questions for today. Okay, no problem. I hope we covered all important things that are relevant for your today's trading. I would like to thank you all for being with us, and of course expect you tomorrow, the last day of the week, Friday 30th of November. We are back at our regular time at 8:00 GMT, 10 o'clock local Cyprus time. Until then, I wish you a nice trading day and of course good and profitable trading. Good luck.